Hello there, everyone, and welcome to our Pellegrini Financial First Quarter Market Update video call here for 2025. Obviously, been anywhere near the TV over the last few months. There's been plenty of headlines to follow, so let's certainly jump right into it. Um, as we started 2025, obviously, markets themselves had picked up right where 2024 left off. It was obviously a phenomenal market in 2024. Markets continued that trend through the first month of January and even to the middle of February, and only then did markets start turning the other way. And I'll have to separate a little bit, I guess, from what the end of the Q1 was versus what's kind of carried on since the 1st of April. But in that first quarter here, obviously, again, markets kind of pulled back from the middle of February to the point where, for the most part, at the end of March, markets were generally flat, or portfolios or performance was generally flat for the year. Nothing significant in either direction, I guess. And since early April, that's been a bit of a different beast. However, when we looked at the specific components of where market performance went in the first quarter, for the most part, it was global small cap and then mostly big tech, or the NASDAQ in particular, that retraced performance. And so, two things there. It goes global small cap partly was, tariffs, of course, and uncertainty in trade wars. I would say the Nasdaq, obviously, there was an influence from that trade issues there as well. However, the Nasdaq in particular and the big tech companies, of course, really were the driving factors in performance over the last couple of years. And so, to see a bit of a pullback on those companies here in the last few months was maybe not unwarranted, but also a little bit more comforting in the sense that big tech isn't going away anywhere. So for it to recover and bounce back is expected. And again, those big companies, they're still a big part of our lives, and they're still big influences in the markets and economy, and performance will follow along with it. As we got into the first week of April and after Liberation Day, of course, in particular, markets really took that bigger downfall. And now this is getting into Q2 a little bit, but as we look at some of the bigger indexes in particular, like I said, in the first few days of April saw some bigger declines. And again, I just highlighted the NASDAQ there in particular that had the biggest drawback. Some of the markets that withstood more of that was the Eurozone, that was kind of flat for Q1, and emerging markets in particular as well that were still positive for the year. China was still positive as well, but again, that's not really a market we get too tied into. When we look at sectors, of course, materials in particular were the top performer in Q1. And again, this is the Canadian sectors. Again, information technology, or technology, of course, and healthcare were the two biggest detractors. When we look at the broad markets in particular, the S&P 500, like they all get and had basically encountered correction territory, 10% drawdowns, and some of them even up to the 20% level of drawdowns. Again, portfolios ourselves didn't reach that level. Obviously, we were flat in Q1 and then turned a little bit negative in the first part of April here. But for the most part, our portfolios have held up rather well, being, again, global, diversified, both balanced and to growth oriented. But again, our diversification is meant to weather some of those storms. When we talk about just more of the dramatic moves, again, this is the early part of April, so again, outside of Q1. But I kind of wanted to point out just quickly, again, market timing, or how to jump in, jump out of markets. That's not what we do, obviously. And quite frankly, no one can really predict what markets are going to do. And this little chart here was just seeing a dramatic rise in the markets on an announcement from Trump, of course, that said tariffs are going to be, put off again. And so all of a sudden markets jumped. And I just highlighted there 12:33 in the afternoon, and all of a sudden markets jumped 3, 4, 5, 6%. And you can't time that. That's not that anyone can time that. And so, again, just being a continually participating in the market is how you ride through those down cycles, but also engaging in the upside of it, because again, you can't just predict these things. When we get into commodities, and so commodities themselves have probably struggled for the most part in this Q1, and I guess we'll focus on West Texas oil first. For the most part, it traded around $70 a barrel. It kind of has come down more closer to 60 over the last few weeks. And again, for the year-to-date perspective, it was down from the start of the year to the end of Q1. One of the top performers was natural gas, which again, take that with a bit of a grain of salt, I suppose, because it's had a horrible month in April. So again, gas has come down quite a bit, but it was a positive contributor commodity wise in Q1. The bottom chart there was just showing really U.S. crude imports, as we talk about oil a lot. Um, the U.S. economy in particular obviously still needs our oil. Again, for Trump to say, well, they don't need anything from Canada. Well, they do need Canadian oil. They need potash. They need other items as well, aluminum, whatever else. But you've seen over the years a declining reliance on foreign oil for the U.S. and a more reliant need from Canada. And so, the U.S. does produce a lot more oil than it did historically. However, they're still, at least about 5 million or 6 million barrels short per day on what they will produce for themselves versus what they consume. And so that is made up by a big chunk of it being Canadian oil. Other commodities that we'll just touch on. Gold, of course, had a very good positive run through the first quarter and even the past year as well. Again, that's been a kind of a temporary safe haven in some respects because a lot of the U.S. treasuries were not as safe as historically, I guess, in nature. So gold has found that to be a bit of a prop up for them, or that asset. When we go to inflation here, we always touch on this a little bit. Inflation, of course, has been, as we've talked about in the past calls, tamed, I guess, is the best way to put it. Two charts here. One shows, of course, this top one here. That red line, or the reddish line, is the Bank of Canada overnight interest rate, down to 2.75% currently. The inflation is the light blue line, which you see, arcing up dramatically in 2021. Took a while for the Bank of Canada and other federal reserves and every other central bank to catch up, but they did ratchet up interest rates to pull inflation back down. They succeeded in that. They are much more in tandem now than they used to be. That's positive and that's good. Um, inflation, of course, and the bottom one there is really just looking at, CPI excluding food and energy, and with food and energy being a bit more volatile. And you see that a little bit in the chart, but both of them now have come close together where it's basically 2.3, 2.4%. That's the Canadian rate. The US might be feeling a bit more inflationary pressures. Part of that could be due to tariffs and, of course, trade wars. One nice thing is technology is a deflationary tool. And now as AI is becoming more and more ingrained across different sectors and scaling these different efficiencies, that is deflationary. But if US inflation then does start creeping up again because of tariffs in particular, well, then that might cause the Federal Reserve to either postpone or delay interest rate cuts that were maybe planned for this year but will not take place. That's yet to be determined. I think there's a lot of factors that are yet to be determined based on trade wars, tariffs, and Trump comments, quite honestly. When we look at interest rates, again, this top chart is purely just the Bank of Canada rate on its own. So, again, 2.75%. We saw that kind of a dramatic increase in 2022 and 2023, peaking out at about 5%. And essentially, we've been cut in half since then. To our current rate, we would expect another rate cut here in Canada, perhaps fairly soon. The bottom chart is more interesting because it is a chart on the gross debt, and it's looking at the U.S., it's looking at Canada, it's looking at the G7, other advanced economies below. But I'm going to look at the top three lines because those are the ones that we're kind of more focused on. But the top line is the G7 average, and so the basic gross debt to, again, the size of someone's economy is what that's relating to. And so the G7 average is the highest of all these line graphs here. The USA is above Canada. Canada actually is falling below the US in regards to amount of gross government debt in comparison to their economy. I mean, they're all high numbers, so it's not like anything to brag about necessarily. However, it is in a more comfortable phase than where the U.S. is at and G7. And let's be honest, not many governments are worried about debt. It still seems, even with higher interest rates. And even the U.S., of course, is still looking to increase their debt ceiling. So it's not like they have any breaks going on to what their spending is. I'm not saying that's a good thing, but again, relatively, Canada is not sitting in a terribly bad position in the grand scheme of things. So we'll move on to kind of the next thing here: employment and GDP. And GDP, more so, the comment around here again is the fact that, again, trade wars, tariffs, all coming into place here. And this first chart at the top here really looks at the amount of Canadian exports, and obviously the top line is to the USA. Obviously, we had a little reprieve and a fallback in 2020 and a significant climb out of that, and then it's kind of been flattened since that in the last year or two. But it's well above what we export to the rest of the world. Now, the one caveat to all this, of course, is Canada, of course, is being threatened, I guess, by the USA and Trump and so on and so forth. We'll see how that turns here with the new elected prime minister. That said, the federal government here has 15 different trade agreements with 50 other countries around the world. And again, those are opportunities for Canada to expand its export market. It's already there, it exists, it can be used and utilized more greatly. I think one thing that'll influence this as well, even as we go through the next year, is the fact that even just energy, now that we can export more through Trans Mountain and oil, the coastal link out to Kitimat for natural gas is almost operational, and so it's ready to ship its first amounts of LNG. That by default will just add to the amount we export to the rest of the world, so that's positive. And so that from that standpoint, obviously Ottawa and Washington are trying to work together to get some kind of agreements in place. That, like I said, that said, we have other opportunities in Canada, and Canadians as a whole need to make most of those opportunities with agreements that are already in place, to be honest. When we look at the economy, both the U.S. economy and Canadian markets kind of diverged a little bit. The U.S. economy was adding more jobs here in March. That kind of changed here more lately. Again, the Canadian employment situation kind of lost more jobs than that they were expecting. As a whole, the unemployment rate edged a little bit higher, 6.7%. So again, long term, and that's the Canadian employment rate at the bottom there, really in that long term trend of between 6 and 7%. And that's kind of where it's been for many, many years. And that is a pretty much base kind of employment rate, anyways. That said, the economies and GDP in particular is going to go through a lot of ebbs and flows here. Um, I know obviously for a fact here more recently, economic growth in the U.S. has been notched down a little bit. GDP numbers are going to look different through time only because of the fact that there's been a lot of front loading of inventories and things like that. That there's suppliers, manufacturers that are all trying to do a lot of this hoop jumping to deal with tariffs, right? As tariffs have come and gone. And again, that's one thing that the markets have never appreciate, obviously, is uncertainty. And I've said this at a number of meetings, of course, with clients, but markets and the economy can generally deal with, if there's a tariff, great. If it's 10, 20%, whatever it is, that's fine. The economy can work with it and figure out how to manage it. The problem becomes when it's increased and decreased, it's put on and then put off and then changed. And okay, well, and it all happens within a day or two. No parts of the economy know what to do. And so to functionally deal with that is the uncertainty that it's creating, both in the economy and in investment markets. As we stand right now, the Q2 market outlook, I mean, most corporate profit expectations remain rather positive. Obviously, there's some downward revisions happening based on trade disruptions and tariffs and costs, however that's going to be incurred. Obviously, geopolitically, I mean, again, we're in a yo-yo stance here with U.S. relations with everyone in the globe. It's not just Canada. Again, that ebbs and flows and can have an impact. Obviously, what was more positive is the fact that fixed income seems quite favorable, and so to have that as a ballast in our portfolios is obviously key and remains there. And I think, there's still markets that have opportunities, international, Europe in particular, of course, and even Canada, to be honest, is a good market to still be invested in. So, again, as much as there's trade disruption and concerns out there, there's certainly a lot of positive and a lot of opportunities out there. So, I'll leave it at that for now. I think appreciate you joining us again for this Q1 market update, and look forward to joining you again here in Q2 coming up shortly. Thank you, and bye for now.